Welcome to Module 3, Section 4, where I will discuss understanding the bid-ask price.
All right, so first of all, let's get into this a little bit and try to understand what is the bid-ask price. Now, at any given time, let's say you own a stock or you want to own a stock, either way. At any given time, if you were to just stop everything and freeze it, like use the pause button on your remote, you would notice that there are two prices for a stock at any given time. One is called the ask or offer price. I don't use the word offer in my slides, but I just refer to it as the ask price. Now, if you were looking to go into the stock market and you want to buy a stock, this is the price you're going to pay if you buy it. You don't own any of it right now. You take some money and you go into the stock market and you want to buy it, you're going to buy at whatever the ask price is at that moment. Now, if you want to sell, okay, you're going to sell at what is called the bid price. I just remember it: bid, sell, BS. Okay, the learning by association or remembering things that way seems to help me pretty well. BS, the price an investor will receive when you want to sell. And so there are two prices, a buy price and a sell price. Each stock is different, but the more volume on that stock, the closer these two prices are likely to be to each other. That's what we as an investor want. We want the bid price to be really close to the ask price. Some stocks that are not traded very heavily, that don't have a lot of volume, the prices could be very different from each other. And I'm going to go through and explain that a little bit here. So for example, let's say you have two stocks that you're looking at. And one is stock A, very inventive name I came up with there. And then you have stock B. Now, somebody used to use XYZ company in all their examples in the books I used to read, but then I think a company actually came up with that name. And I think there's an ABC company. So I just go with stock A and stock B. Okay, on the stock A, about 10,000 shares trade every day. Now, is that a lot or is that not very much? Well, you have to know, and you have to measure it compared to other stocks in the market to see if that's a low amount or a high amount. Where stock B, they trade 10 million shares a day. So that has a lot more interest. So on stock B, the bid-ask price will probably be a lot closer to each other than in stock A. You might have what's called a larger bid-ask spread. So for example, they're both at $10 a share, okay? And you like them both, and you want to invest in both of them. So let's look at their bid-ask prices. If you wanted to go in and buy, you are going to pay $10.05 per share. That's to buy. Let's say that, you made a mistake, and you immediately, that same instant, a microsecond later, you decide you want to sell and the bid-ask price has not changed, you could then sell it for $10 per share. So you see a little bit of a difference there? You're going to pay 5 cents per share more to buy at that moment than you would get if you sold for $10 a share. So we take those two, here's the ask, here's the bid, and we say that the bid-ask spread is then 5 cents. Now, you might be okay with that, but you might not be okay with that because there are some stocks out there that have really wide bid-ask spreads, and you're going to get a lot less than maybe even the last traded price. So let's look over at stock B. It's also $10 a share when you're looking at it, and you see that, I can buy this right now for $10.01. And if I wanted to immediately sell that, I made a mistake or I had buyer's remorse or something, I could immediately sell that for $10 per share. So the bid-ask spread on that is 1 cent. That's a lot closer. And this is a very big part of what happens in the market, and a big part of some of the concepts that I teach is dealing with the bid-ask spread. So here's just an example. You can see at the very top in yellow, there's a bid of 2081.25 and an ask of 2081.50. You just subtract the ask from the bid, the bid from the ask, and you get a 25-cent bid-ask spread. Now, if you look down through these numbers, you'll notice, on the second one, there's a 75-cent spread, and then it gets all crazy as you go further down this list. And this is what I watch, and this is what other investors watch. When they're looking to get in, they're watching the ask price. When they're looking to get out, they're watching the bid price. It might be different than what you see scrolling across the bottom. Or you might have software like I use where if the last price was at the ask, it comes up green. Poof. If the last time that stock traded was a sell, it comes up red. Doesn't mean it's gone negative. It just means that was a sale, not a purchase at that point. Okay, let's see the bid-ask price in action, or I should have said prices right there because there's two, so it should be plural. So anytime the markets are open, usually Monday through Friday, if you live on the East Coast, it opens at 9:30 a.m. If you live on the West Coast, that's 6:30 a.m. If you live in another country, it could be tomorrow. I don't know. So it'll just depend on where you're at in your particular time when the markets open or close. But these bid-ask prices, they change all the time, even several times within a minute. You get a stock like Microsoft, Google, or some of the heavily traded stocks, they're flying all around. That thing can trade 100 or change 100 times in 1 minute. It's going up and down, up and down, up and down all the time. So these changes can even occur if nobody buys or sells the stock at that time. You might have a stock that you've held on to for a while and it doesn't trade an awful lot. And so you're watching it, you're looking maybe to get out or maybe to buy more, and no trades are taking place, but you see the bid ask moving up and down during the day. That still happens. It just means what they're willing to buy or sell the stock to you right now would be if somebody was to actually do that. So it can change many, many times. So if there are a lot of investors who want to buy a particular stock, the market maker, that's who they actually go to. That's the person, just to keep it really simple. They're standing there and they have, okay, 2 lines, everybody. Anybody who wants to buy is in this line. Anyone who wants to sell is in this line. And then they can see the length of each line. And so they know, I can change these prices and let's see if those lines actually change. Okay, and I'll go through some of that. So the market maker who is selling you the stock, if they see a big long line in the buy line, they will keep raising the price. Because remember, they're selling it to you. You're buying, but they're selling it to you. So doesn't it make sense that they want to get the highest price possible? So if they see a whole lot of buyers there, they're going to keep pushing the price up. Well, eventually the price is going to go to a point where, the line's now empty. There's no more buyers. So maybe I'll keep it the same. Well, there's still nobody in the line. Maybe I'll drop it a little bit. Oop, nobody in line, drop it a little bit more. Oh, now there's a few people in line. Okay, that's the new price that we will have. And just the inverse happens when you're going to sell a stock at that point. So if there are a lot of investors who want to sell a stock, the market maker who is buying the stock from you, you're selling it, they're buying, they will lower the bid price until sellers are no longer interested in selling. And a lot of times when you get the whole long line of sellers, that's kind of when you have what's called a market crash. There's a whole lot of sellers and not many buyers. And so you get everything pretty lopsided at that point. But somebody has to be on the other side of each transaction, even if it's the market maker themselves. Sometimes they do that. So when there are the same number of buyers and sellers, then things are even. If you see 5 people in the buy line and 5 people in the sell line, and they're all kind of happy with the current bid-ask price right now, the stock price will just stay the same. And some stocks do that. They might trade for a period of time at the same price. But then if you start to see this imbalance, one way or the other, of buyers or sellers, this causes the stock price to move up if there are more buyers, or to move down if there are more sellers. Remember that it's the game of these two prices right now. It's buying and selling. And folks, if you wanted a holy grail to the stock market, this is it. This is how complicated it gets. Now, it doesn't mean it's easy, but this, as far as understanding how the stock market works, in its very basics, this is it right here. There's really not a lot of additional things going on. Now, it can get more complicated, and you need experience to know how to work these things the right way. But as far as understanding the concept, this is pretty much it. You have buyers and sellers. They come together in a place called the stock exchange, which might be a physical place, or it might be over a computer. One agrees to buy, one agrees to sell. Everybody's happy. We go on to the next one.
This concludes Module 3, Section 4, and I will pick things up again in Section 5.